flourishing, but also more broadly in the infrastructure spaces across the world, especially in Europe and the States.
Definitely so. Thank you so much, Third Street. We'll look out for that. Well, meantime, commodities, also another sector that had a stellar rise last year, but maybe not this year, according to the K1 Group. Find out why next.
Left intercept the final bearing 222. 730.
Siam Cement Group, or SCG, has always been the forerunner in providing society with a clean and healthy environment through its business. While continuing its expansion in ASEAN, SCG's 5 businesses, including chemicals, paper, cement, building materials, and distribution, strive to promote the prosperity, growth, and well-being of every country in which it operates.
At SCG, we make it our social responsibility to provide a better environment and a better quality of life for everyone with our products and services. We feel that sustainable growth is an important ingredient for the good development of society and the improvement of everyday lives.
Hence, sustainable growth goes hand in hand with our company's business culture and practice. SCG, drawing the future.
A rare souvenir, 125 Egyptian pounds. A meander along a river, 250 Egyptian pounds. Vehicle rental with driver, 115 Egyptian pounds. Lessons learned out of school, priceless. There's some things money can't buy. For everything else, there's MasterCard.
In business, time is money. You need to act fast. You need to stay ahead. Now CNBC gives you the global edge you need. Worldwide exchange. Live reports from the US, Europe and Asia get you vital market info first. Because in business, there's no prize for second place. Worldwide exchange. Weekdays on CNBC. First in business worldwide.
Welcome back. Well, commodity prices had a record run in 2006, their 5th straight year of gains. We saw many raw material prices scaling new heights on strong global demand. But Nico Haraji, managing director of the K1 Group, does not expect that record run to continue this year, at least not broadly within the entire commodity sector. He expects below average returns on broad indices, but he says look out for high returns from certain sectors like agriculture and precious metals. He joins me now live out of Hong Kong. Niku, thanks for joining us today. You know, when you look at 2006, the major factors that drove the commodities boom there were fund inflows, a lot of it from hedge funds. We also saw global demand very strong, you know, with at least in the first half of the year, the U.S. housing sector still showing strength there, and also tight supplies in the market. Do you see these same factors playing out in 2007?
Well, yes, indeed we do. We see several of 2006 themes remain in place for 2007, including tighter supply in metals and agriculture than in energy, for example. We see reasonable, supportive global demand, and we see ongoing financial flows. Together, however, these factors suggest another year of below average return on the broader market, but we do think that we can see some high returns generating from agriculture and precious metals. Now in 2006, as you said, we have seen a 2-tier commodity cycle. Commodity indices posted the worst aggregate performance we have seen since 2001, down around 15%. However, this combined performance clearly marks what has been a 2-tier commodity price cycle. Now, we have seen energies down around 22%, whereas we have seen base metals up 65%. Yeah, I would think that they outperform even the most bullish analysts in the beginning of the year. We have seen precious metals up around 20%, and we have seen agriculture up around 11%. All of these sectors going up to their decade highs.
Okay, well, Nico, let me just jump in real quick here. Let's talk about these sectors that you are very bullish on for 2007, precious metals and agricultural commodities. How much upside do you see in them, and what specifically would be the one or two driving factors that would make these sectors outperform the others?
Well, we clearly think that the diverging supply trends will be a factor. Now, if you look at the commodities in 2006, which have had low inventories, or actually, high inventories and above average, they've actually fallen, such as crude oil and natural gas. Whereas if you look at other commodities where we have critical low inventories, such as in corn, wheat, nickel and zinc, they have in fact rallied a lot. That's why we think that the best pick of 2007 will be the agricultural commodities. This sector has been the worst performing throughout the current commodity price cycle. However, total returns since 2002 stand at 16% compared to a 3- to 4-fold increase in energy and metal prices over the same period. The bullish view is driven by the tightening market balance that we're seeing in corn and wheat. Now, we saw 2006 corn and wheat close at the lowest inventory levels we've seen since 1983. Even though we have seen price rallies anticipating this tightness, we still believe that prices will overshoot valuations as long as the debate about alternative fuels remain prominent.
Nico, good morning to you. I just want to put a question to you about base metals. Do you expect that particular commodity sector to be negative next year? Because one of the features that we've been following is increasing cost pressures for miners coming from higher labor costs, higher input costs, etc. Do you expect that to be a factor next year, and do you expect that to give rise to tighter supplies?
Well, we sure do, and we have seen this sector's performance outpaced even the most bullish analysts' expectation in 2006. However, given the low inventories of this sector as a whole, the sector is likely to grind higher until a demand shock materializes or the supply response will become more forceful. We think that both these developments will happen in the second half of 2007. Our general expectation for base metals, however, for 2007 is a very poor. We think that the prior year has given us enough time to expanding mine productions, and we will see production will become meaningful, and we will see investment passion for metals will unlikely be more aggressive than we've seen in 2006.
And if I can switch focus to the agricultural commodities, you touched upon them a little earlier in the conversation. Australia is undergoing its worst drought in more than a century. How big a factor do you think that's going to be in influencing global wheat and grain inventories this year in 2007?
Well, this is a scary situation, and especially when we look at the international market, it hasn't been made better, actually worse, by poor domestic harvests in large importing countries such as Brazil. We also had India, the second world largest producer, coming out announcing that they are planning to import significant quantities of wheat for the first time in 6 years, aimed at high demand for domestic food distribution programs. So we are seeing growing consumption, low inventories will offer support for prices in 2007. So we are very bullish on wheat, and we forecast an average price of around $5.13 per bushel.
All right, Nico, it's more here. Very quickly, oil was the big focus that we saw in 2006 because we did see it reaching new highs from the middle of the year. But then since then, it's really paired off. OPEC also saying that it's reducing supplies yet again starting in February. How do you see the oil picture playing out in 2007? And you obviously don't think this is going to pose big returns for investors. Why not?
Well, we think the energy will be the poorest performing sector. However, having said that, that is based on a fundamental forecast. We think oil is likely to trade in a range around between $55 to $70. OPEC production cuts should provide a floor at around 55. However, with any upside stemming from geopolitical events or extreme weather. However, these cases are very difficult to foresee. Now, so we have to, for example, if we see the tensions in the Middle East, if Iran, as they have threatened, will not produce and sell the amount of oil that they have done in 2006, I think that we could see the highest prices in oil. But as I said, from a fundamental point of view, I don't see oil prices going a lot higher.
Okay, Iran, though, being the wild card there. Niku, thank you for joining us today. That's Niku Haradchi, Managing Director of the K1 Group. Well, CPI data out of Indonesia today may force the central bank to scale back the size of its rate cuts. Arnold Gay has a preview of those numbers, also a check on the early move.